This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest bonus monthly podcast from AJ Bell, all about investment trusts. I'm Dan Coatsworth, and joining me is Laith Khalaf. Hi there, Laith.
Yeah, hi Dan. We've got two key themes on this episode of the podcast: collecting a regular stream of cash from your investments, and also making a mint from shares.
Now, we're going to go big on income. We're going to talk to the brains behind two investment trusts that have different spins on how they manage to line shareholders' pockets with cash on a regular basis.
Yeah, first up, we're going to be talking to Joe Dowling, who helps to manage the Invesco Global Equity Income Trust.
Now, I've also got Iain Pyle from Shires Income. He's going to be on the show to explain how he uses some alternative ways of generating an income rather than just simply investing in shares and collecting the dividends from them.
Yeah, and Tom Sieber from Shares Magazine is also with us to talk about trends with premiums and discounts.
Now, at the end of the podcast, I'll be talking to Richard Staveley from Rockwood Strategic. He's going to be talking about holding on to star performers in your portfolio and what it takes to find stocks that make 5 to 10 times your money.
Yeah, before we get into all of that, it's time for a quick roundup of the news in the investment trust space. As I say, Tom Sieber from Shares Magazine is with us. Tom, what has been happening?
Yeah, thanks, Laith. Well, I guess the main thing that's been happening, and it's a trend which has been evident for quite some time, is consolidation. Partly that's linked to persistent discounts in the investment trust universe. I know that's a topic we're going to return to a bit later on, but two of the most recent mergers have been in the Association of Investment Companies Europe sector. Now, arguably, UK investors are still quite slow to put their money to work with continental European names. You know, in terms of their overseas exposure, they're probably more focused on the US. And that might help explain why some of these vehicles have struggled to gain much traction. So back in February, Henderson European launched a review of its options for its future following the sudden departure of two managers, Tom O'Hara and Jamie Ross. And it's come to the conclusion now, it seems, that a tie-up with Fidelity European Trust is the best outcome for shareholders. So those Fidelity European will take ownership of a trust with net assets north of 2.1 billion, and that will be managed by the current co-managers of Fidelity European, who are Sam Morse and Marcel Stozel. And then European Assets Trust and European Smaller Companies, the latter of which has forged quite a strong track record recently under Janus Henderson investors Ollie Beckett, are also going to merge, and Beckett will be in charge of the enlarged fund. And based on the net asset values as of the end of May, you're looking at a vehicle that will be worth around £780 million. As well as kind of mergers between trusts, we've also seen some outside bids, particularly in the renewables and infrastructure space. And there's been another of those recently with Downing Renewables and Infrastructure recommending a £175 million takeover from its largest shareholder, Bagnall Energy. Now, it's pitched at a 20% plus premium to the current price, but there could still be a bit of frustration on the part of holders because the deal is nonetheless being pitched below net asset value based on the latest estimate.
Yeah, okay, thanks, Tom. Interesting to see all that kind of takeover activity and, as you say, more consolidation in the investment trust sector. Let's move on and have our first guest for today. I think it'll be a really interesting one for lots of listeners. Dan recently caught up with Joe Dowling from Invesco Global Equity Income to talk about where and how he looks for investments to generate a steady stream of dividends for shareholders. Let's hear what he had to say.
I'm very pleased to be joined by Joe Dowling from Invesco Global Equity Income Trust. So, Joe, thank you very much for joining us. Hope you're well.
Thank you very much indeed, Dan. Yeah, very well. Thank you so much for having me on. Really appreciate it.
Well, excellent. Well, we're talking lots about income on this issue of the podcast. And so what better question to start our conversation by asking, kind of what's the key to a successful income fund? I'm just wondering, obviously from your experience, is it all about picking those stocks that pay dependable dividends? So your income stream to your shareholders is ultimately nice and smooth, or is it also about finding stocks that give you some capital growth as well?
That is a really difficult question to answer. And I guess one of the things that I've observed over my career is there are so many different ways to make money for your investors and be successful on their behalf in this industry. But I can talk about what's worked for us. And you're exactly right. For us, it has been that combination of dependable dividends, capital growth. And, I guess I'd take you back to when Stephen and I were first setting up this fund. What we really wanted to build was a product that we felt our parents could invest in and that we'd also want to invest in, that could deliver income, but also growth over time. We want our investors to have a growing income stream and a pot of capital that we hope is much, much bigger by the end of their investment journey. But that also to us means a portfolio that works across market environments. We don't want to expose our investors to unnecessary risk. We want to perform in an all-weather manner, and we want to protect their capital in market drawdowns. So, yeah, I think it's that combination that's key, because to us, if a company can maintain a strong balance sheet and give us cash back and grow that stream and reinvest in the business, then that is an indication that the company is doing something really special, that company has a moat, that company just gushes cash flow, and that management team is allocating that cash flow really well. And then once we've identified a company like that, it's our job to buy a diverse portfolio of them at attractive prices. So yeah, that I think has been our kind of mantra and what has led to good returns so far, touch wood.
Okay. I mean, there's sort of talk of investors reallocating money from the US to places like Europe and UK, where valuations are more attractive. Perhaps there aren't sort of as bigger concerns around sort of a real big pullback in the economy. So I just wondering if you thought the current rotation that we are seeing in the markets actually might have benefited anything that you've got in your portfolio. Because I did notice that the trust is now trading slightly above a premium to the value of the underlying holdings. That's the first time in 4 years. So it's quite interesting to wonder why, what are the reasons behind that?
Yeah, so I guess there's two separate questions in there, which I might kind of split them into constituent parts. So I'd say I think the discount has narrowed for a few reasons. One, we relaunched the trust back in 2024 to focus just on the global equity side. So there were 4 different sleeves before. Now it's just our global equity fund. So I think that simplification of strategy has been really important. The second thing is that the board have been great in allocating capital. There's a 4% yield at the headline level that they manage out of capital, and they buy back shares regularly as well, which helps. And then thirdly, we've had a good period of performance. But I definitely contest the point that we benefited from that reallocation, actually. I think when you look at the stocks that have benefited in Europe, it's things that are very geared to a change in macro policy. So it's things like defense stocks like Rheinmetall, or it's European banks. Actually, I think our portfolio of stocks is built to kind of march to their own drumbeat, and that's what we think we've seen. They've paid their dependable dividends, they've grown those dividends, they've grown their cash flows, and they've just kept kind of on chugging. And I think that's what we focus on. What I would say is that on a relative basis, there has been some benefit from us from having less of the kind of expensive US tech stocks that got quite frothy in 2024. We're very valuation driven, so we don't tend to have too much in the kind of highest flying sectors. So we have benefited on a relative basis from that. In absolute terms, I think it's been all about the stocks actually, rather than the rotation.
Okay. I mean, when I look at income investment trusts or income funds, quite often they'll have the same sort of exposure, same sort of sectors. So things like banks and utility companies. And I guess, these are sort of industries that pay out nice dividends. But is it because that they're sort of low growth? They don't actually have much need to spend money in their business. They're not building factories. They're not plowing money into loads of big tech things. So they're going to be paying things out. Is that why, is this a sort of a key hunting ground for you for opportunities?
I think this is a really good question. And actually, it kind of highlights something that I think we do quite differently to many income funds. For us, we want businesses that can pay us a dividend, grow that dividend, and provide us with capital growth. And a lot of those sectors you mentioned, they're great dividend payers and they pay you a lot of income, but they just don't have much opportunity for reinvestment. And that negates, or often not always, negates the potential for really strong capital growth as well. So I think our focus on companies that can grow and pay dividends is different to a lot of competitors. And hence we don't have those kind of typical overweights in those really yieldy sectors like telecoms or utilities or whatever it is. We actually have a lot of investments in sectors like exchanges or private equity, technology. It's a little bit more diverse because we are hunting for that income and growth, not just those kind of big dividend payers.
Is that not, if you have a sort of a sector like private equity, obviously when things are going really well, that they'll be swimming in cash. But what happens when, say we get a recession? Are you finding yourself being tested because perhaps they can't give a smooth dividend stream? It's either feast or famine.
Yeah, well, I think it depends on the stock. So the best example of this would be 3i in the UK. They are a private equity trust, but they don't take on any additional outside capital. So it's more like a mini investment trust itself, or a Berkshire Hathaway. It's a big conglomerate of assets. Their biggest investment is Action, the discount retailer, that's kind of like somewhat similar to a B&N here in the UK or a Costco or something like that. And that, in my mind, is just the most fabulous business. Their prices are 40% lower than competitors. They're growing the store count really rapidly. Same store sales growth are growing kind of 5 to 10% a year. This is a really great growth stock. But because it was hidden in a private equity company, it was undervalued. So those are examples of what we're really trying to do. We're trying to find great opportunities on a bottom-up basis. This is a company that, when we started investing, had over a 3% dividend yield, growing 15 to 20%. And I think since we first invested, the shares are up many, many fold. So that is the perfect example of the kind of sector that most people don't really pay much attention to, that's actually much less risky than it looks on the headline, that's given us that growing dividend and the capital growth. So if we could find a few more of those, that would be great. But yeah, that was a really kind of interesting stock-specific example that I hope answers your question.
Yeah, I mean, something like, you also say you look at some areas like technology for opportunities. I mean, I guess there's a definite trend for companies using spare cash for share buybacks, and that definitely applies to tech sector. Now, some of them will be paying dividends as well. What, as an income manager, what do you prefer, that they prioritize dividends first and then perhaps share buybacks is a bit further down the rankings in terms of how they allocate money? Or actually, is there a benefit to you that if they're spending quite heavily on buybacks?
Yeah, well, I think I'd answer that in a couple of ways. I think we really focus on companies that, when they pay a dividend, maintain or grow that dividend. Having a dividend that's not dependable is its own kind of risk in a way, I suppose. But a great example for us of exactly what we're looking for in the tech sector is something like Broadcom. Broadcom manufacture all sorts of different semiconductors that are in these niches with very little competition. What that results in is exactly what we're looking for, that kind of growing dividend stream and potential for capital appreciation. So when we were first buying Broadcom, I think it had over a 3% dividend yield. That dividend had historically compounded around 15% per annum. And what you notice is when the shares get treated, they launch a buyback on top. So earlier this year, they announced a $10 billion buyback during the kind of tariff volatility. And for me, that's a really good example of what we call and stocks. We're looking for a strong balance sheet and a growing dividend and buybacks and reinvestment. And those things are quite rare. So we really pay attention when a business is able to do all of those things at once, because it speaks to something that is profoundly cash generative and doing something quite special.
Okay, I mean, just finally on the subject of tariffs, I mean, how is what we've seen this year impacted the stuff that you've got in your portfolio? Just wondering, are any of them sort of actually in the going to be negatively impacted by this, or actually, some of them benefit because they might be not directly impacted, but their rivals might be, and therefore they can. Is this an opportunity for them to sort of step in and potentially take some market share?
Yeah, definitely. So what I'd say is we have executed the same kind of playbook we would run for any kind of crisis or unexpected event, whether that's something like COVID, whether that's interest rates going to 5% or plus, whether that is something like the tariffs we've seen. First, we look to risk. So you're exactly right. Something like a Canadian Pacific Railway is a railway in the US that runs from Canada to Mexico. Superficially, there could not be a stock that is more impacted by Canada and Mexico getting tariffs than something like Canadian Pacific. But what you can do is go back to Trump's first term and realize, actually, here's a company that got a real whack when he announced tariffs that first time. But they almost doubled their EPS during his tenure and paid a really healthy growing dividend. So you can do things like that and think, okay, well, here's a company that's being unfairly punished. This is a kind of artery of the US economy, and unpicking it would be catastrophic. So they can exert that kind of pricing power as supply chains are reorganized. So that would be a really good example of kind of trying to root out risks and understanding where actually there's a perceived risk, but it might be an opportunity. Second thing, exactly to your point, there are some companies that are using this to their benefit. Again, another example would be 3i here. So the discount retailer Action, that's their biggest holding. The first thing those guys do when someone like Amazon is pulling back on their China supply chain due to tariffs is get on a plane, go to China, and try and get the best possible deals they can. Step into that vacuum left by Amazon. And then they can give all of that benefit back to customers. So they buy broader, deeper, better products, give those prices and that quality back to their customers. And that's a great example of, I suppose, a management team that wants to use crisis to their advantage. And that's exactly the kind of team that you want to back and partner with over the long term. So yeah, I'd come back to this mantra that we have of kind of focus on the bottom up stocks and make sure that your kind of analysis is correct before thinking anything's an opportunity. But every time there's volatility like we've seen this year, there's always something to do. There's always some bargains to pick up, and there's always some research that you can do that can help you go the extra mile and hopefully make some extra money for your investors.
Well, Joe from Invesco Global Equity Income Trust, thank you very much for joining us. It's been fascinating to have you on the podcast.
My absolute pleasure. Thank you very much, Dan.
That was Joe Dowling from Invesco Global Equity Income. We're now going to go back to back on the income theme to hear from fund manager Iain Pyle on how he does something a little bit different to achieve a market-beating dividend yield. Iain runs the Shires Income Trust, and Dan recently spent some time learning about his process. Let's hear from him now.
I'm very pleased to be joined by Iain Pyle, who's a fund manager from Shires Income. So, Iain, thanks ever so much for coming on to the podcast. It's great to see you.
Morning, Dan. Thank you very much for having me on. It's a great pleasure.
Well, brilliant. Well, I thought it'd be really interesting to talk about Shires because it's a little bit different from perhaps sort of a normal equity income style investment trust. I guess you could say a normal one would just go ahead and buy shares in different companies, and it takes the dividends that are generated from those holdings and essentially uses that to fund the investment trust sort of payment to investors for their income. Now, with all investment trusts, they can dip into revenue reserves, they can sell small chunks of capital if need be, but you do something in addition to sort of these options, which is I guess it gives. I don't say it's unique, but it's unusual in the investment trust world, which is looking at preference shares, convertibles, and fixed income securities as a way of generating extra yield. So this, perhaps, could you talk through sort of the process of how this works and how that enables you to pay a little bit more sort of high yield than you might see on many other investment trusts that are focused on income?
Yeah, absolutely. I mean, if we kind of go back to first principles and think about what Shires is trying to do for the end investor, then the number one target is to have a high level of income. That's really what we're providing for people. And a yield at the moment of about 5.8% is materially higher than what you get from the benchmark. It's about 60% higher. But we also think is that attractive compared to bonds or compared to cash and other places people can put their money to earn income. And we see that level as attractive. We think it's about the right level. We think if we push it much higher than that, you end up taking on a bit too much risk, because from our point of view, what we want is not only high income, but we also want that to be resilient and defensive. And we want both income growth and capital growth over the long term as well, because we want to provide something that cash or bonds can't really do. They can't really do that growth that equities can. And the problem you find, I think, with equities when you try and push into high income is that you're trying to solve a trilemma, I guess. You want growth, you want safety, you want income. But by chasing a high yield, you have to push into things that are probably less growthy because they'll be on a higher multiple. And they're probably more risky as well because the market places a discount on risk and therefore gives you that higher yield. So the way we kind of get around that problem and give hopefully a really attractive total solution is by having a portion of the portfolio in fixed income. At the moment, it's about 20%. It's been pretty stable at about 20%. And the great benefit we get from that is that we hold preference shares or fixed income instruments that have a high yield. So at the moment, they have a little average over 7% yield. They're also very defensive. They sit above equities in the capital stack, so they get paid out first. They're preferential over equities. And they're perpetual. So you know you're going to get that high income into the future. And that brings a number of benefits for the portfolio. I think obviously you get high yield. That's great for us, trying to hit our income targets and hopefully grow the dividend over time. But it's also very reliable. They're also defensive. So if we see a downturn in equity markets, these things tend to be much more resilient and you'll get some outperformance from that. And importantly, because we're getting such a high predictable yield from the fixed income element, it gives us a little bit more flexibility in the equity portfolio as well. So we can hold some things there that are not just about delivering high yield. They might be about dividend growth or about capital growth. And that allows us a bit more flexibility, allows me more flexibility as a portfolio manager to try and give that total return outcome for clients along with a high income.
Well, it might be worth explaining exactly what is a preference share and how does that differ to perhaps a stocks and share that the average person might be familiar with.
Yeah, so preference shares are a bit of a old-fashioned instrument, mainly issued by UK financial companies back before our time. And you don't get many of them now because they're fairly expensive for the companies to issue. But they are effectively sitting halfway between debt and equity. And the benefits are you get a fixed coupon like debt, so you have a very predictable income stream. They are above equity in terms of preference. So if a company is insolvent, you have a right to your funds back before equity holders. And in most cases, if a company stops paying dividends from its preference shares, it can't pay dividends to equity holders. And when they want to restart dividends to equity holders, they need to restart dividends to preference shares first, and in most cases make up the arrears as well. So a really nice defensive income instrument. And I guess like fixed income, the downside is you have a fixed capital value that won't grow over time, although the traded value can go up and down over time.
I mean, I certainly have come across certain types of funds where they sell options as a way of generating additional income to top up dividends. Is that something you do as well, or are you still clear of that?
Yeah, so we did it historically, Dan. We used it for many years, and we have, I would say, de-emphasized it in the last couple of years or so. And that's not that it was a bad decision. It worked okay, generated a bit of excess income, and we tended to write options which were consistent with how we would trade in the equities anyway. So we weren't taking any particular risk. But what we found was that although you've got a little bit more income, it wasn't really that material. And of course, when your options do exercise, as a writer of options, you lose money on that because you're either selling below the current market price or buying above the market price. And we found that the overall total return gain was not material. It created I would say, an extra layer of confusion for clients that just wasn't worth the additional effort. So for us, we've de-emphasized it. It's still there in our locker. It's in our toolkit. If we feel the need, we really want to generate some income from options, we can go and do it. But I wouldn't say it's an important part of the investment style.
When someone is looking for an income generating investment, quite often it might be someone in retirement or just about to start retirement. They're thinking about, I need to replace what I used to get from my monthly salary. I want my investments to essentially pay the bills. I think obviously people want to get as generous a yield as they can, but equally not take excessive risks. So would you say yours is a bit more, your Shires is a bit more sort of defensive style? Trying to give as a big as yield as possible, but really not risking people's money by backing the type of companies that they could do brilliantly, but if something goes wrong, it would really hurt perhaps their share price.
Yeah, that's right. I mean, we will have things in the portfolio that will be relatively high risk, but when we put everything together, including the preference shares, we would aim to have a beta of less than 1, which basically means that we'll go up slightly less than the market and we'll go down a bit less than the market when the market goes down. I think that's very consistent with what clients want. It's consistent with protecting wealth and delivering income. But we are focused on delivering capital growth over time as well. You don't want to just stand still. So that's an important part of what we do. And I think the point you make about trying to push high yield and take on a bit too much risk is very true, because the UK market is a great market for income and there's lots of opportunities out there. But you find once you get much above that 6% level or so, you are getting almost exclusively into more cyclical sectors, financials, energy, mining, etc. And that can work in your favor for periods of time, and sometimes for quite long periods of time. But if you want something that is going to be long-term growth, then you can take on a bit too much weight in those cyclical sectors and find that when it's not in your favor, actually, it is quite painful.
Yeah. So I guess where are you finding sort of perhaps more sort of defensive sources? Is this like areas like utilities and tobacco?
Yeah, I mean, we have utilities, definitely. And utilities, I think, have done pretty well over recent years. I think can continue to do well, particularly if bond yields start to come down. And they have that great outlook for stable regulated growth and stable dividend payments, which is very consistent with our target. Tobacco, yes, we held Imperial Brands over the last year. It's been a fantastic performer, which has been really good. And a great example, I think, of a company that is valued cheaply by the market, but the underlying quality of it in terms of cash generation and then using that cash methodically to buy back its own shares and pay dividends creates a really good investment outcome over time. In terms of other sectors, I think we want to have quality, but we want to have attractive prices and good yields. So we tend to find we're looking for areas of the market that we think are good quality, but where the market maybe disagrees slightly. We've got to find those uncovered gems a little bit to get high yield and quality. I think in recent years, a couple of sectors have stood out from that point of view for us. One has been UK banks. I think everyone thinks UK banks are very cyclical and they have this memory of the financial crisis 15 years ago. But those underlying businesses are very stable. The majority of lending is into UK mortgages, which don't default. And they've all got this fantastic interest rate hedge position, which means that their returns over the next few years are going to continue to grow and are very well protected. So that kind of higher return, actually surprisingly defensive, good quality businesses, which the market doesn't appreciate. And the other one, I think, has been UK construction contractors, which is, I think, in the eyes of the market, a really kind of cyclical, high-risk sector. But it's a sector that's been through a huge amount of repair. Much like the banks post the GFC, the contractors had their crisis the last decade when companies like Carillion and Interserve collapsed. And since that point, we've seen balance sheets strengthened, we've seen consolidation, and importantly, we've seen contract structures with the government change as well. So the risk sits with the buyer rather than the company. And right now, you have more defensive companies, but with an outlook for work and for growth supported by investment in infrastructure and utilities in the UK, which is as good as it has ever been. So you've got companies in the portfolio like Morgan Sindall, Kier, and Balfour Beatty, which have a great outlook ahead of them, but they're still valued quite cheaply because the market has that memory of these things being quite high risk and quite cyclical.
Yeah. Well, brilliant. Well, Iain, thanks so much for talking through what you're doing with Shires. It's really fascinating stuff. So been great to have you on the podcast.
Dan, thanks so much for your time. I appreciate it.
Thanks again to Iain Pyle from Shires Income for coming on the podcast.
Right. I'm going to pass the microphone over to Tom so he can talk to you, Laith, about premiums and discounts to net asset value. There's some interesting things going on there. So,
yeah, thanks, Dan. So, Tom, let's start with discounts, shall we? There's quite a lot of substantial discounts which can be found across the investment trust sector. Just before we dive properly into where the wheres and wherefores, or the whys and wherefores even, let's just remind everybody what a discount and premium is, Tom, and why they exist in the investment trust market, please.
Yeah, of course. So a discount or premium in terms of investment trusts is best understood as the gap between the share price and the net asset value per share. So net asset value is the value of the trust's assets minus any liabilities. And you can divide that by the number of shares in issue to get a per share number, which you can then obviously compare against the share price. Now, the reason these premiums or discounts exist is because of the structure of trusts. So unlike other types of funds like OEICs and unit trusts, they have a fixed number of shares. And if there's less demand for those shares, then they may well trade at a discount. And equally, if there's quite heavy demand for the shares, they can trade at a premium.
Okay, so what's the state of play across the investment trust market as a whole, and where can the biggest discounts currently be found?
Yeah, so if we look at the data from the Association of Investment Companies, the average for trusts as a whole, stripping out 3i, which is a bit of a kind of outlier in the trust space, so that the average without 3i is around 14%, and that is pretty wide by historical standards. And the average discount has actually been in double digits since 2022, and that's the longest period on record that we've seen double-digit average discounts in the trust space. There's 26, or certainly when this data goes back to late May, but at that point there were 26 investment trusts which traded on a discount more than 5 percentage points greater than their 5-year average. And just to look at a couple of individual examples of this, life science investor Syncona had gone from trading at a premium to net asset value for quite a number of years to trading more than 50% below its net asset value. And something that we're definitely seeing is that investment trusts that have exposure to private assets, so assets that aren't listed on the stock market, are among those which trade at the largest discounts. And that kind of reflects increased investor fear about market conditions not necessarily being that conducive to selling stakes in private holdings. Another example of a trust trading at a much wider discount than the average over 5 years is Lindsell Train Investment Trust, as investors were prepared to pay a high price to get exposure to the Lindsell Train asset management business, Nick Train being a star manager for sort of a number of years. But that's changed more recently as the performance of both that trust itself, but other vehicles from the Lindsell Train stable struggling.
Yeah, okay. And so quite prevalent discounts. There's a lot of things going on in the market, which, we've discussed here previously. For instance, investors' preference for passive funds at the moment, which doesn't really favor investment trusts. We've also, I think, had a lot of more competition in the last couple of years from cash interest rates, obviously, particularly when you think perhaps about some of the kind of income generating trusts in the infrastructure sector, which people might have previously turned to for income. Perhaps they just thought, well, actually, I can get that sort of income nowadays from cash with much less risk. But with discounts so prevalent across the industry, there are some trusts, Tom, which are trading at a premium, and some at quite a substantial premium, right?
Yeah, that's right. And actually, the number of London-listed investment trusts which trade at a premium has moved higher over the last year, as investors are sort of showing some willingness to pay up for some sort of types of strategies. So you've got 24 investment trusts now trading at a premium to net asset value, and that compares with 19 a year ago. But it's quite a long way off where we were a decade ago. So back then you had 88 investment trusts trading at a premium, and that was around a third of the kind of all trusts at that point. Now, the trusts that are currently commanding a premium are those typically which specialize in income, have potentially a track record of beating the market over the long term, or they kind of provide access to, some kind of unique, unusual asset that lots of people want to get exposure to. So just in the kind of income space, you've got the likes of City of London, a name that's already been mentioned on the podcast, the recently restructured Invesco Global Equity Income. And then there's a bit of a curious case with JP Morgan Emerging Europe, Middle East and Africa. It used to be JP Morgan Russian Securities, and it trades at a 300% plus premium to NAV.
Okay, that's substantial.
Yeah, just a bit. So that's because investors there reckon that the value of its Russian assets, which have effectively been written down to zero thanks to the Ukraine war, are worth more than zero, essentially. And that, say, Donald Trump is able to bring an end to that conflict, or that there is some kind of peace agreement there, that will unlock the value of those assets.
Yeah, so it's almost kind of a distressed asset
exactly.
type trade, isn't it? It's like these things might have no value, but there's a small chance that they might have some value. And I guess for some investors, that's enough to get them sniffing around. So there are some trusts here trading on premiums, a lot trading on discounts, of course. If we just take a step back and just think about, if you're thinking about investing in investment trusts, how do you approach this, Tom? What should you think about discounts and premium? Should you only be buying things that are trading on a discount? Should you consider things that are on a premium, or vice versa?
Yeah, I mean, I'm going to be a little bit annoying here and go with an "it depends" answer. I think it partly depends on your time frame. If you're looking to sort of the very short term, then the fact that a trust trades at a discount might be interesting to you. But I mean, I think generally the answer to your question is no, you shouldn't buy a trust just because it's trading at a discount, and nor should you ignore a trust because it's trading at a premium. I mean, there's a lot of reasons why a trust might be trading at a discount, and it's not necessarily, there's not always going to be an obvious catalyst that can change that. It could be that the trust trades at a discount because it's a poor performer. It invests in a sector that's up, not very popular with investors. The investment style is out of favor. It might have just struggled to gain traction. We were talking about some of those European trusts earlier that perhaps just haven't kind of proved all that popular with investors. And obviously there are things trusts can do to bring down the discount. They can buy back shares, which reduces the supply of shares, and that can be effective in reducing the discount, but it's not guaranteed to be. So I think the discount or premium, that's something to look at, certainly. And when you're kind of considering an investment trust, it's part of the consideration. But you also obviously you need to look at what has the long-term track record been like. What is this actually invested in? Am I comfortable with that? So I think it's useful context, but it shouldn't be a sort of determining factor in making your decisions as a prospective investor.
Yeah, for sure. I guess if you're kind of investing over, say, a 10-year horizon, maybe investing in equities, you're getting, you hope, something like 7 or 8% a year from your investment, closing a discount of, say, 5% down to 2% over 10 years. It's nice, but it's only a very small tailwind to your returns, isn't it?
Exactly.
Right, thanks for that, Tom. I think it's now time for our last guest, and it's an interesting one if you've ever wondered how certain investors just happen to strike it rich. Dan caught up with Richard Staveley from Rockwood Strategic a few weeks ago to talk about stocks that generate supersized returns. Here's what he had to say.
Well, I'm pleased to be joined by Richard Staveley, the fund manager from Rockwood Strategic. So, Richard, thanks very much for coming on the show. Hope you're well.
I'm very well. Thank you very, very much, Dan, for having me on.
Well, brilliant. Well, I want to talk about really successful investments. I think investors would love to own something called a 5 or 10 bagger. By that I mean you make 5 or 10 times your money. But I know in Rockwood you're certainly starting to see some really big winners in there. But I wondered, from your experience as an investor, how do you go about spotting ones that really have this potential to make very large returns, and actually also avoid the ones that might sound brilliant but actually could prove to be duds?
Well, Dan, I think the answer is not going to be exactly what you expected, because we very, very rarely know at the start that an investment's going to be a multi-bagger investment. And I actually think very few investors will claim they have a secret sauce for spotting them. They're actually pretty rare in investment. And I think we're recording this during Ascot week. And, you go to the races and everything's 10 to 1, 15 to 1 or whatever. And you can, lots of horses are. And that's a kind of multiple like that. The investment game, really, if you can just double your money in a share over 5 years, literally a 5-year holding period, you make 15% a year, and you will smash all the fund managers and all the market indices, and you'll be one of the best investors of all time. So whilst we want to have them, trying to find them is a bit of a needle in a haystack. That said, we do, and we have done. And I think the characteristics are quite clear about what it takes. The first thing is you need to start off with a really, usually quite a bad situation. So there's some sort of reason why the stock market doesn't hate it. It doesn't like it. They hate it, in fact. And it's sort of down on its luck, or it's some sort of recovery situation. And then the only way you can move to making more than 1 times your money in those sort of situations is that it becomes becomes exposed to a big growth opportunity. And if you look at all the 10 baggers and the 5 baggers, this term we use in the financial markets. It means 5 times your money or 10 times your money, a bagger we call it. They are all businesses where growth has continued and been very, very significant, but they are rare. I can talk about a couple we've had, but what I would suggest is that when I was thinking about this, is that quite a few of the companies I invested during I've been doing this 25 years now, career, have gone on to be 10 baggers, but I've not owned them for that period. I've maybe made a good return, and then they've become a lot bigger. And because I run a small companies fund, I've just sort of moved on with my life. But literally in the FTSE 100 right now, there are a range of companies that I invested in when they were literally 200 million pound companies, like Rotork or Cranswick, Diploma, Spectris, which has just been taken over. It used to be 250 million. It's been taken over for billions. Hiscox, the insurer, all these things, which we made really good returns in, but then gone on to do extremely well.
Yeah, because I think one of the most difficult things is actually to sort of have the nerve to hold on to your winners. I mean, I certainly know if I had something in my ISA that, say, got a 50 or 100% return, I was thinking, crikey, I'll potentially get out while the going is good. But what sort of stops you from cashing out potentially after you've sort of doubled your money?
Yeah, it's a great question. And this phrase, running your winners, is a really powerful phrase to make sure that keep you in stocks that are doing well. Now, I think there are 2 factors behind it. The first is actually having a clear view of what you think the value of the share should be, not being passive or hoping or guessing or just watching it without really thinking about what the value could be. But if you look at, say, a simple price earnings ratio, the multiple of profits, you go, well, it's on 10. I think it should be on 15. And that allows you to keep running it, even though it may have gone up 100%, but it's not on 15 yet. You can keep holding it. So you have to have some sense of what you're aiming for, and that can keep you in, even if the return is big. We complement that with both a valuation sort of target, a level of valuation, and also a profit target. So we go, right, we think this business is making now this level of profit, but in a few years' time, it'll make this. So you then, irrespective of how it does, what you can then hold on with confidence through to that point. I think one of the other more behavioral aspects is and this keeps people in, and this is very valuable. I think I had this advice early in my career, helps you stay in things when bubble-like characteristics are happening. Sectors, say like resources sector bubble that happened in the UK market a few years ago, or the TNT T bubble, is that whilst if you're still running your winner strong and everything's fine, you don't get if everything is good from the company's perspective, what they're saying positive, then you shouldn't be aggressive about selling it, like very aggressive. You can take a bit of profits, but don't completely exit and move on. And occasionally there'll always be someone that says, I got out at the top. But you stay in until you start to see anything that isn't quite what you expect. But then that's when you have to act. And most people, their problems are they run it up, make loads of money, but then when the bad news starts to come, they then don't sell. It's actually more rather than locking it at that point. So it's staying in maybe longer than necessary, but then being very disciplined if things get bad about selling.
I guess are people giving a company a benefit of a doubt, thinking, well, you've rewarded me before. Everyone sort of has slip ups now and again. I'll stick in there for a bit longer. Is that sort of the sort of the mindset people are in?
Yeah, I think there's a thing called ownership bias, which they did a great survey on, which is Dan, if you like walk down the street and you saw a 20 quid note on the pavement, and once you check, no nice person just dropped it behind you and sort of like that, and you put it in your wallet, the emotional response you get from that, getting that £20 is sort of good. You have an emotional response. If 5 days later, you went to buy a couple of pints for you and a mate, and you opened up your wallet, and a £20 note that you'd earned was not in your wallet, and you'd lost £20, the emotional response is about 3 times as bad. So the thing is, there's this loss aversion, and then there's this valuing something you own more once you've got it than it is if you don't have it. If you see what I mean. So I think it's dealing with those behavioral aspects is really key.
Yeah, I mean, you mentioned earlier you could give some examples of stocks that you've got perhaps now or recently in your portfolio that's done really well. I think I spotted Filtronic in Rockwood's portfolio. I mean, have you made 5 times your money on that? Because that certainly had a fantastic run on the market recently, isn't it?
We've actually made now 12 times our money on it. Yeah. We actually first started buying the shares at 12p a share, and it's been an incredible journey we've been on. We did not think we'd make our 12 times our money. We thought we might make 3 times our money at the early stage with what we knew. And what's driven it it was sort of forgotten about. It was a £25 million business when we bought into it. That part of the stock market that Rockwood focuses on, where other larger investors just don't bother with anymore or look at very much. So it was not much coverage. And they've been explaining, although the business had been around for many, many years and had strong proven technology, and they'd explained to anyone that would listen that this opportunity was going to open up for a new market for their products in space. And they were speaking to the leading companies in low Earth orbiting satellites in space. And we've worked out relatively quickly that was almost certainly SpaceX. But they hadn't won any contracts from it. When we looked at how the business was being run, they had net cash. They weren't, they're solid base. They were profitable anyway, but their factory was only about 60% full. And the products that they sell typically make about 60% profit margins if they sell a bit of the kit. So we knew if they did start winning more orders and growth, that profit would just literally all drop down into profit. They wouldn't need to expand the factory or anything like that. So we had this huge increase in profits, and also a huge increase in the potential market size for Filtronic, and that's what's been driving the shares so far. Now we have needed to iterate our value of what we focused on for the share with the new information that we received since, because now when we first invested, they would say they were talking. Now they're winning. Then they've announced they've done a strategic partnership. And in fact, Elon Musk has actually bought shares in Filtronic. We think it's the only share he's bought in the UK, which is quite exciting. And he obviously, I'm sort of proud to say, but not wanting to be too, but he obviously paid a higher price than we did, which if I ever have the honor of meeting Elon Musk, I will sort of be a bit, I'll tell him about, of course. That business now, with Filtronic, we still continue to analyze whether we've got the right potential value for it. We know other sophisticated investors believe it could still become a £1 billion technology company. We're at about 300 million now. In order for them to do that, to keep going, they would need to get their products into the satellites themselves that go in the Starlink satellite network that is offering this satellite broadband service around the globe. At the moment, they've only won contracts with them to go into the ground stations. And I think everyone that's on this call will probably think intuitively there are far less ground stations than there are satellites. So there's a little bit of, in the valuation now, there's a little bit of hope that that's going to happen, but it's not priced as if it's definitely happening yet. So if it starts to happen, then we would increase Nitro, I hope to hang on. Now, as it happens, we have publicly stated that we have reduced our position and taken some profits. I think that's the sensible thing to do. When it was valued cheaply, it's not as valued as lowly as it was. But we're running our winner, like I said before. I just give one because where you started, because I think it's worth it. There's a company called Ashted that many AJ Bell clients might have heard of, which does hire equipment into America and the UK. I bought those shares for a previous fund I was running at the bottom of the financial crisis at about 30p a share, and they recovered very strongly, and I think I 3x'd my money. And obviously this is many years, 15 years ago, and I was very proud and very pleased I made a really good return. Ashted has gone on and on and on and on, and I think well, you probably know, but I don't follow it anymore. It's far too big for Rockwood, but I think it's sort of £20 a share, or something like 15 or £20 a share, and you can see how it is. So I've now, with Rockwood, with the benefit of my live experience and iterating my learning processes, I'm making sure I'm running things and and be prepared not to take everything off the table too early.
Yeah, I mean, just obviously with even though you've been sort of trimming the Filtronic stake, obviously that its success must have had a pretty impressive influence on Rockwood's overall performance. So I know that as we're recording this, you've just published your full year results. I mean, I know you outperformed the market, but perhaps could you just sort of talk through very sort of briefly how sort of the scale of this outperformance that you've achieved over the last year?
Yeah, so absolutely, Filtronic's been a strong contributor in the 12 months to March, and since March, and in the prior year too. Although Funding Circle, which is another business we've invested in, was also, I think, almost as much in terms of performance contribution, which is a business that lends. It's a platform that lends. Facilitates the lending of money to small British businesses, small SMEs, from hairdressers to flower shops to dry cleaners, that sort of thing. It's where the mainstream banks don't bother with anymore. We identified that in January of last year, where they had that Funding Circle had 250 million cash sitting in the bank, but the stock market was only valuing it at 125 million pounds, the whole business, and they'd invested 100 million in the platform. So we started engaging with the business, speaking to the shareholders, former management, the advisors, analysts, research, and took a stake. Now that's gone up 3 times since over 300% in the last 12 months. So that's also been a big driver. Because we're concentrated, so we think one of the issues with many fund management things is that they're overly diversified. So they're winners. They're great to talk about, that some fund managers talk about, but they actually haven't really moved the dial. So that's why we're quite comfortable having just 2 or 3 things in our 23 stock portfolio being the big out winners in a particular year, and hopefully they sort of pass the baton on to something else the next year. We had one of the other ones, for instance, that's been great, which is quite ostensibly what you're quite a boring stock, but Galliford Try, the construction business for an infrastructure across the UK, builds hospitals and schools and is involved in water infrastructure, sorting that all out for the water companies. I mean, that also, because of its size, was being ignored by the stock market and was trading less than its cash. So we bought Galliford Try, and that's now gone up 100% in the last couple of years as well. So I think that's been another driver. RM Group, which is an educational business we're involved in, it supplies 90% of the UK primary schools, and it's also the world leader in the assessment of exams. It has the contracts to do the exams for the International Baccalaureate, for the Institute of Chartered Accountants, and Cambridge Assessment, which will be marking my daughter's A levels, but there's no help for shareholders in that regard, sadly. But that company, we've got about 12% stake in Rockwood in it, and that went up about 40%. So that added a good 4% itself to performance.
Excellent. Well, Richard, thanks so much for talking through what you've been doing, and this concept of winning stocks. It's been brilliant to have you on the podcast.
Thanks again to Richard Staveley from Rockwood Strategic.
Thank you very much also to everyone at home for listening or watching this episode. We're now going to be taking a break with the Investment Trust Show until October. But don't worry, we still have the weekly normal version of the AJ Bell Money and Markets podcast in the meantime. We appreciate you tuning in. We'd love to see your feedback. Please do leave a review wherever you can. But we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.